Things to keep in mind while investing in US markets from India. This is our topic for discussion today in the Market Secrets investment series. Let's start with one of the most important aspect, which is tax implications. Let's start with the taxation for investing using direct option. When you invest in the US stock markets directly through international brokers or Indian brokers which has tie up with the international brokers, there are two types of taxation events. Number one, taxes on investment gains. This is nothing but your capital gains. You will be taxed in India for this gain. Taxes will not be withheld in the US. The amount of taxes you have to pay in India depends on how long you hold the investment. The threshold for long-term capital gains is 24 months with a rate of 20% with indexation benefits. If you sell a stock in less than 24 months, the capital gains are considered short-term and you will be taxed according to your income tax slab. Number two, the taxes on dividends. Unlike the capital gains from the investments, dividends will be taxed in the US at a flat rate of 25%. Fortunately, US and India have DTAA, that is Double Taxation Avoidance Agreement, which allows taxpayers to offset income tax already paid in the US. However, availing proof and paperwork for DTAA is not straightforward. The 25% tax you already paid in the US is made available as FTC, that is foreign tax credit, and can be used to offset your income tax payable in India. So these are the two different taxes that you need to pay if you are investing in the US markets directly. Now coming to the taxation on indirect option, India-domiciled mutual funds and ETFs holding more than 35% of their overall portfolio in the foreign stocks are taxed similar to the debt mutual funds and provide indexation benefits on long-term capital gains after 3 years. If you are holding these funds for more than 3 years, the gains will be taxed at a flat rate of 20% with indexation. If you held it for less than 3 years, your gains are added to your overall income and taxed at your income tax slab rate. Remember, this is applicable only if the mutual fund you are investing in is holding more than 35% of their overall portfolio in foreign stocks. If it is less than 35%, then it will be taxed just like any other Indian equity mutual funds, which has a lot of tax advantages. While Indian equity funds have an advantage over international equity funds when it comes to taxation, taxation shouldn't be the most important criteria if one is investing for the long term and one is investing according to one's asset allocation. Also, one must keep in mind that tax rules can change over time. So moving on to the other factors, under RBI's LRS, that is Liberalized Remittance Scheme, resident Indians can invest up to 250,000 US dollars, that is approximately 1.8 crore rupees per financial year for any permitted current or capital account transaction. Investments in US equities must be made in US dollars. So you have to first wire, that is wire transfer or remit the US dollars to your broker's partner bank in the US to fund your investment account. In order to do this, the investor must fill out the LRS form, also called as Form 2, and submit it to their own bank. Also, on placing a withdrawal request, the money should be wired directly to your bank account in India. It may take up to 3 to 5 business days for the wire transfer to come through. When it comes to regulations, the Indian securities market regulator SEBI does not have effective oversight of these entities. So the investors should verify that the brokerage they are investing through is registered with SEC, SIPC and FINRA, which are the primary US regulatory bodies. If you opt for indirect option, some of these funds might be funds of funds, that is India-based mutual fund, which simply buys units of another fund investing in the US markets. This another fund is called the underlying fund. For instance, the Franklin India feeder Franklin US Opportunities Fund invests in Franklin US Opportunities Fund, which is an international fund investing in the US stocks and run by Franklin Templeton in multiple countries. Investors should note that the total expense ratio, that is TER, shown in the fact sheet of such funds usually only includes the TER of the feeder fund, that is the fund that you are buying. The underlying fund also have its own fees, that is management fees or its own expense ratio. The actual expense incurred by the investors will also include this and will usually be the sum of both of these. That is, your effective total expense ratio will be total expense ratio of the fund plus total fees of the underlying fund. So it will be combination of both the expense ratios. So if you take Franklin India Feeder, Franklin US Opportunities Fund as an example, as of 2021, its fact sheet mentions its expense ratio is 0.61 percentage for the direct plan. Like we mentioned earlier, it invests in another mutual fund. And the underlying fund's fact sheet mentions a management fee of 0.7 percentage. So for the investor, the total expense charge will be 1.31 percentage. It is advisable for Indian investors to also go through the prospectus, fact sheets, or other such scheme documents of the underlying fund to get a better idea of any hidden fees and charges. So these are the things that you should keep in mind while investing in the US markets from India. If you think we have missed out on any, please let us know in the comment section. Also, if you have any queries, please drop it in the comment section. We'll be happy to answer it. As always, hit the like button if you have liked this video and share it with your friends if you find it useful. Also, subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.